Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, big focus on equity markets this week. We've obviously had a stellar set of earnings from the US, and we have more earnings upcoming from major markets in China. And markets, of course, have performed very well, so there are some changes to our views, which I'm looking forward to discussing in today's conversation. So on that note, very happy to be joined today by Rajat Bhattacharya, who's Senior Investment Strategist in the CIO office. So welcome, Rajat. Thanks for joining us again. Let's start with that point on equities. I know there have been some changes to our view, especially after the strong performance recently. Could you help our listeners just understand exactly where we made tweaks to our views?
Hi, Manpreet. Yes, that's correct. So on 5th May, we took some profit on our overweight view on Asia ex Japan equities, which have performed very well. In fact, they've outperformed in year to date, and rotated some of those profits to European equities, especially Euro ex UK equities, which have underperformed this year. Now, the global equity rally is likely to broaden in the coming weeks, driven by potential US-Iran deal that could reopen the Strait of Hormuz and restart Middle East energy flows. While our investment stance remains overweight in global equities, including in US equities following this strong earnings season that you referred to, we thought it was prudent to lock in significant gains from the overweight view on Asia ex Japan, as well as in semiconductor equities, and rotate to Europe to capture the broadening rally.
Thanks, Rajat. So really rotation and rebalancing while keeping that core holding on Asia ex Japan. But could you maybe help dig a little bit deeper into the rationale behind those changes, and including in Asia, which markets we still like?
Sure. So this year's rally in the global equities has been highly concentrated, with nearly 50% of the gains attributed to the semiconductor industry. Now, this has benefited our overweight view on Asia ex Japan, which includes semiconductor leaders or powerhouses, as they're called, including South Korea and Taiwan. While our structural bullish stance on the AI revolution remains intact, the AI rally is entering its next phase, where downstream beneficiaries such as internet platforms, which are key customers of semiconductors, are expected to increasingly capture value. A more balanced positioning across tech related markets and industries is therefore prudent. Hence, besides closing our overweight on Asia ex Japan, we also closed our opportunistic idea on global semiconductors, locking in significant gains. Now, we remain the overweight US equities, as I mentioned earlier, which are likely to deliver the second highest expected earnings growth of almost 19% over the next 12 months. And that is just behind Asia ex Japan, which are actually likely to deliver 46% earnings growth over the course of the next 12 months. However, as the rally broadens, we expect Europe ex UK equities to benefit from the AI adopters across the industrial, financial, consumer, and healthcare sectors. Meanwhile, Asia ex Japan's year to date strength has been led by South Korean equities, which we have where we have really a core allocation. Now, we continue to prefer a diversified approach within this region. Taiwan offers exposure to structural semiconductor growth, while China offers valuation re rating potential due to its valuation discount amid stable policy and AI developments. Meanwhile, India offers non tech, domestic driven growth at reasonable valuations.
All right, so let's maybe switch gears to the other key topic today, the US-Iran sort of conflict. Now, you're quite optimistic that a potential US-Iran deal to reopen the Hormuz Strait can be reached. So can you give us a little bit more detail on what gives you that confidence, and what you see as the key market implications?
Yeah, the US Iran deal looks likely mounting economic pressures on all sides. So, to start with the US, the gasoline prices there have surged above $4.50 per gallon, and President Trump's approval rating is falling. Meanwhile, the Hormuz Strait blockade is increasing pressure on Iran's oil industry and its economy. Finally, China's intervention this week, where the foreign minister met Iran's foreign minister, urging Iran to reopen the strait, which comes ahead of the next week's crucial Trump and Xi Jinping meeting, could be the decisive factor leading to a deal. Now, a restart of Middle East energy flows should lower near-term inflation expectations, which have surged over the course of the last couple of months. Now, while major central banks are likely to hold rates in the near term, as they see this near-term inflation expectations rise, the Fed is likely to ultimately cut later this year as the latest oil shock weighs on growth with a lag. Now we are watching the April's jobs report tonight very closely. The U.S. inflation report comes next week, and those will be key factors in the Fed's decision. Although, in terms of Europe, although the ECB has set the stage for a June rate hike amid rising inflation, markets may be underestimating in my mind the medium-term growth impact of an oil shock. We expect one ECB rate hike this year in June versus market odds of two to three rate hikes. This policy outlook, I mentioned there, the Fed rate cut plus ECB hikes less than expected, means bonds offer attractive risk reward for investors seeking to lock in yields. Now, recent hawkish repricing has pushed bond yields to the middle or upper bound of our 3 month range, creating a tactical entry opportunity for selective tenors in the near term. For longer term positioning, reports of a potential Middle East deal present an opportunity to lock in yields in our preferred 5 to 7 year maturity buckets. Now, we would extend duration if front end yields rally meaningfully or if the term premium subsides sustainably. A delayed conflict resolution remains a big risk, of course, I must add, potentially reintroducing long end volatility over the longer maturities of bonds. Now, encouragingly, central banks are viewing this oil's inflation pass through as manageable, reinforcing our view that the Fed will look through the near term spike and resume rate cuts in the second half of this year. Under this backdrop, we believe US inflation protected bonds serve as a good hedge in the portfolio against inflation.
Okay, switching gears maybe to a different, geographical location. So this week we had intervention in the dollar yen bond market, currency markets. So, in your view, what drove the intervention, and I guess what's your outlook on the yen following this week's events?
Indeed, the Japanese authorities have intervened in the FX markets since 30th April for the first time, I must say, in 2 years to support the yen as dollar yen crossed 160. Now, this signals they do not want further yen depreciation given its negative impact on imported inflation. However, FX intervention is a stopgap measure. The Bank of Japan is likely to hike its policy rate potentially as early as June to bring it closer to inflation. The Bank of Japan is under pressure to prevent rising wage driven inflation from unanchoring long term inflation expectations. Given all of this, we expect the dollar yen to fall over the course of the next 12 months towards 152, with the BOJ hiking by 50 basis points by December and the Fed cutting rates by 25 basis points over the same period.
All right, and finally, the RBA in Australia raised rates against this week. Does that challenge your bullish view on Aussie bonds?
Yeah, the RBA hiked policy rates by 25 basis points to 4.35%. But we remained positive on Australian corporate bonds because we see the decision as a signal of peak RBA hawkishness rather than the start of a more extended tightening cycle. Governor Bullock actually was clear and she signaled a likely upcoming pause to assess the impact of the recent tightening. Importantly, the RBI's downgraded 2026 growth outlook suggests policy is already restrictive, which should cap further rate hikes. We believe this explains the calm reaction in Australian corporate bond yield premia, which remain range bound after the RBA decision. Given these factors, the Australian corporate bond yields and yield premium remain attractive in my mind. Now, Australian dollar strength adds an additional layer of support for total returns on the bonds. Aussie dollar versus the US dollar has appreciated almost 2% since we initiated the idea, bringing it close to our 3 month target. Now, Australian dollar gains versus the US dollar are likely to resume later in 2026 as expectations build for a Fed to resume rate cuts in the second half of the year.
Okay, well, we'll end the conversation there for today. Thank you, Rajat, for taking the time to speak to us. Top three takeaways from the conversation today. Number one, in our view, we see room to rebalance within global equities, trimming profit in Asia ex-Japan overweight and rebalancing towards the euro area. Second, of course, within Asian equities, maintaining that overweight on China, Taiwan, and India equities. And finally, Aussie dollar bonds, we still think are an attractive, area to consider, both for currency gains as well as the yield. So, thank you very much for joining us in the conversation today. We hope you enjoyed the podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.